Hello and welcome back to Simple Money, the show where we explore important personal finance topics in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. So this week, we continue our discussion on income taxes, a super dry but important topic to make the most out of your personal finance situation. Today, we talk about how you can save big through tax deductions and tax credits. This is one way that the wealthy use to get financially ahead. If you haven't listened to the last episode about income tax basics, I encourage you to check it out to really benefit from this week's episode. So the difference between an income tax deduction and tax credit is pretty massive. An income tax deduction directly reduces the taxable earning during the calendar year, while tax credit reduces the amount of taxes that you owe. So let's look a little bit deeper into income tax deductions. So as mentioned, income tax deductions directly reduce the amount of taxable income that taxes are applied against. So for example, you would only pay income taxes on $40,000 of income if you had total income of $50,000 but $10,000 in deductions. So some of the biggest tax deductions are RRSPs and pension contributions, eligible childcare expenses, union payments, moving expenses, business losses, and other capital losses. Later this month, I'll be releasing some episodes that focus just on childcare expenses and retirement deductions. So after all deductions are applied to your total income, then you are left with your taxable income, which is what your total outstanding taxes are calculated on. These total taxes owing can then be reduced by tax credits. There are quite a few tax credits out there, and there are conditions applying to every single one of them. For example, some of these tax credits can be passed on to spouses or applied in future years. Tax credits are termed as refundable or non-refundable. A non-refundable tax credit means that you will not receive money back if these tax credits exceed your total taxes owing. Refundable tax credits are simply the opposite. Maximizing the benefits of tax credits are one of the ways that wealthy households minimize the amount of taxes that they have to pay. So to do this, first you need to know about the tax credit, and then you can take it even further by understanding the details of that tax credit. For example, charitable donations in Ontario can generally receive a tax credit of 20.05% when the amount is under $200 a year. However, it's 40.16% for all amounts over $200. So this is really helpful to know, but there is additional details that can take this tax credit even further, such as that charitable donations can actually be carried forward for up to 5 years and even shared between spouses. So you can see how this can strategically be used to maximize the amount that you get from this tax credit. If anyone wants to learn a little bit more about charitable donations, you could check out episode number 5. So some of the biggest tax credits that are worth checking out are the basic personal amount, the age amount, medical tax credits, tuition tax credits, and caregiving expenses. Of these, we'll be exploring the basic personal amount, medical tax credits, and more later this month. That's basically it for today's episode, but one of my big recommendations is if you do your taxes this year, to read about all deductions and tax credits that can be used, because you never really know what you're going to find. So what I'm going to do is I'm going to post a governmental link that lists all tax credits and deductions available to Canadians for the 2017 tax year. Thanks again for listening. I hope that you enjoyed the episode. If you have any questions or comments, you can find me on Twitter at ffcoach, or you can email me directly at info@ffcoach.ca.